All right. So hopefully everyone's able to log in and see everything. Good afternoon. I'm Matt DeBay, tax partner here at Lane Gorman Trubitt, and I want to welcome you to today's webinar. For those of you joining for the first time today, Lane Gorman Trubitt is a mid-sized accounting firm for all business sizes. We cover a broad range of topics that are impactful to businesses in the construction, M&D, dealer services, real estate, and not-for-profit industries. This webinar will be available as a recording within a week or on your YouTube channel following the event and will be sent to your email. This is a continuing professional education event, and you will receive 1 hour of CPA credit upon completion of the class evaluation. Throughout the presentation, any items that may come up, we ask that you please submit any of your questions to the Q&A function at the lower part of your screen. All right, with that out of the way, I'm excited to introduce Aiden and Swaroop. So joining the firm in 2016, Swaroop is a tax manager with more than 7 years of experience. Her work concentrates in the real estate and manufacturing/distribution niches, where she has held various roles. In her current role, she trains staff and seniors, as well as offering guidance in the compliance process. She also plays a vital role in the review process of tax returns with an emphasis on meeting client expectations and planning needs. Aiden's a tax manager who joined the firm in 2018. During his 8 years of practicing in taxation and public accounting, Aiden has worked on different areas of income taxation, with partnerships being his passion. He serves clients in the real estate and construction niches. At LGT, Aiden's focus on tax compliance and client service are his top priority. His daily tasks include training staff by helping them through the preparation of tax returns, reviewing tasks for accuracy, tackling complex research projects, and assisting clients with tax compliance and planning. With that, I'm going to hand it over to Aiden.
Hello, everyone. Welcome to the 2023 Tax Planning and Beyond webinar. So for our agenda today, our discussion will include the Tax Cut and Jobs Act provision. There's some permanent and temporary provision in the Tax Cut and Jobs Act, and we're going to be discussing them today. And also, we're going to be talking about the Inflation and Reduction Act that was passed in August 2022. The act was designed to cut the domestic greenhouse gas emission, and as well as control the high inflation that we have seen for the past couple of years. And at the end of the webinar, we're going to be cover some of the key items that some taxpayer can consider when they do tax planning or prepare for the next tax seasons. So let's get started with the permanent provision under Tax Cut and Jobs Act. So for individual taxpayer, there are going to be no more deduction for alimony payment. Some of you may remember prior to the Tax Cut and Jobs Act, individual taxpayer used to be able to deduct alimony payment, and the recipient of the payment would have to include the payment as income. But starting in 2018, the taxpayer doesn't have to include the payment as income, but the payor of the payment would not be able to deduct the payment as a deduction on return anymore. No more reversal of the Roth IRA conversion. In general, an individual payer can elect to treat a contribution made to one type of IRA to another type of IRA. This is something we call the conversion contribution. Prior to the Tax Cut and Jobs Act, an individual taxpayer can reverse that conversion contribution to a Roth IRA. However, the Tax Cut and Jobs Act disallowed that, and this is effective in 2018. Now, a taxpayer can still convert a contribution from a traditional to Roth IRA, but they can no longer reverse that conversion contribution back to a Roth IRA. Repeals of the penalty for failure to have a minimum essential coverage. Some of you may remember before 2018 tax year, individual taxpayer would have to pay a penalty if they don't have a minimum essential coverage for a full taxable year. But the Tax Cut and Jobs Act basically repealed that mandate, and taxpayer doesn't have to pay a penalty even if they don't have a health coverage for taxable year. Section 529 plans, prior to the Tax Cut and Jobs Act, funds from 529 plan can only be used to pay for college or university expenses and receive the tax-free treatment. But the Tax Cut and Jobs Act basically expanded the use of the Fund 529 plan. Now, individual taxpayer can use 529 plan to pay for K-12 tuition, such as a private school, elementary school, or secondary school. But there's a limit how much you can use to pay for those type of expenses. And the limit is 10,000 per year. So any amount that over 10,000 pay for those kind of expenses going to be subject to income tax and the 10% penalty. 1031 exchange, prior to the Tax Cut and Jobs Act, property eligible for LICA exchange include personal and real property. But the Tax Cut and Jobs Act modified the rule and now only allow real property to be qualified for LICA exchange. Charitable contribution, before the Tax Cut and Jobs Act, if a taxpayer made a payment to or for the benefit of a college or university in exchange for the right to buy a ticket to a sporting event, 80% of the payment could be deducted as a charitable contribution, but that would be for the Tax Cut and Jobs Act. Now, the Tax Cut and Jobs Act basically disallow the deduction for that payment. There's some other permanent provision for businesses. The Tax Cut and Jobs Act imposed the 21% tax rate for C corporation and also eliminated the corporate AMT tax. Section 179, Section 179 deduction is limited to a certain threshold amount, but before the Tax Cut and Jobs Act, the annual limitation was $500,000 per year and started to phase down dollar by dollar if the total expenditure under Section 179 exceeds a certain threshold amount. And that threshold amount was $2 million before the Tax Cut and Jobs Act. The Tax Cut and Jobs Act basically increased the annual limitation from $500,000 to $1 million. And the phase down threshold amount increased from $2 million to $2.5 million. And also expanded the definition of the qualified property under Section 179. Now, qualified property under Section 179 include certain improvement to non-residential property, such as roof, heating, fire alarm, or security system. Cash method of accounting, there are several limits on the use of cash method of accounting. And one of the limits is the rule that taxpayer generally cannot use the cash method of accounting if the average annual gross revenue was more than $10 million. But the Tax Cut and Jobs Act basically increased that threshold amount from $10 million to $26 million. And the figure is subjected to inflation. So for example, in 2023, the threshold amount would be $29 million. And it's up from $27 million that will apply in 2022 tax year. So what it means here is that, more small businesses can qualify to use cash method of accounting. And this can be a good tax saving opportunity if a taxpayer can qualify to elect and change method of accounting from accrued to cash and defer more taxable income in the current year. The taxpayer may want to reach out to their tax advisor to go through the analysis to see if they can qualify and benefit from making the change of accounting method. But overall, I think the procedure to make the change of accounting method from accrued to cash could be simple by filing a Form 3150 with the return. Entertainment expenses. Before the Tax Cut and Jobs Act, certain entertainment expense can be deducted up to 50% if the taxpayer can establish that the expense was sufficiently business related. However, the Tax Cut and Jobs Act disallow the deduction for entertainment expense, regardless of whether the expense related to a trade or business. A side note, visit meals was 100% deductible for 2021 and 2022, but starting in 2023, it go back to 50% deduction. NOL, before the Tax Cut and Jobs Act, NOL for any tax year can be carried back 2 years and carried forward 20 years. And the NOL deduction is limited to 100% of taxable income for those years. But the Tax Cut and Jobs Act modified the rule, and now NOL can only be carried forward indefinitely and not carried back. And also the NOL deduction would be limited to 80% of the taxable income for those years. Carried interest. Carried interest, also called profit interest, is any interest other than capital interest. For example, a partnership can issue a carried interest to a partner, give them the right to receive some profit in the future if the partnership meets some target, even if they don't contribute any cash into the partnership. So before the Tax Cut and Jobs Act, long-term capital gain distributed out from the partnership to the partner who have the carried interest can treat the long-term capital gain as long-term capital gain on the return. But the Tax Cut and Jobs Act imposed the 3-year holding rules on the carried interest. So what it means is that if the underlying asset that generated the long-term capital gain was held less than 3 years, the profit interest partner would have to treat that long-term capital gain as an ordinary income. So what it means is that the partner who received the income from the carried interest may have to pay more taxes because the income would be subjected to ordinary tax rate as compared to the more beneficial long-term capital gain taxes. So those are some of the permanent provisions under Tax Cut and Jobs Act for individual and businesses. I wanted to take a second and see if anybody have any question.
One question that I have, that 21% tax rate looks pretty lucrative. What type of client, what type of taxpayer would be ideal to switch to a C Corp to take advantage of that rate?
That's a good question. So as I mentioned earlier, Tax Cut and Jobs Act impose 21% tax rate for C corporation. And you may think this is lower compared to the individual income tax for some taxpayer. And why not every business to be a C Corp and pay that flat 21% tax rate? There can be many reasons, but one of those reasons is that C corporation can be subjected to double taxation. So to answer your question, Matt, I think the best candidate is going to be business that want to keep the money in the business. So without paying the dividend income to the shareholder, the corporation only subject to 21% tax rate. I think the taxpayer may want to reach out to your tax advisor to get a better planning or analysis to determine whether or not they should change to a C Corp. But the analysis is going to be different from one payer to another taxpayer, and it's based on the different specific facts and circumstances. But that's a good question. Do we have any other question?
One more, I guess. With all these permanent changes, I guess it's more of a question on, we have a lot of permanent changes. So what are the temporary changes that we should start considering as well?
Yeah, that's what I'm going to be talking next. I want to talk about some of the temporary provision under Tax Cut and Jobs Act. So I guess the first question is going to be, why do we have a temporary provision? So as we know, the intention of the Tax Cut and Jobs Act is to lower taxes for individual and C corporation taxpayer. So to comply with the Senate budget, and also making sure that the federal budget deficit doesn't increase after the 10 years, the Congress made some of the provision only temporary and set to be expired at a certain date. And I think the majority of this provision going to be expired in 2025. So what are they? I'm sorry. The next slide, I think some of the sunsetting item for individual taxpayer. One of the item is the tax rate for individual taxpayer. The individual taxpayer have 7 tax bracket, and before the Tax Cut and Jobs Act, the tax rate went from 10% to 39.6%. That would be for 2018. But starting in 2018, the Tax Cut and Jobs Act basically lowered the tax rate for certain bracket. And as you can see here, the maximum tax rate right now for individual taxpayer is at 37%. But this sunsetting provision is going to be expired in 2025. So starting in 2026, we're going to go back to the higher tax rate. Charitable contribution, starting in 2018, the limit on cash contribution was increased from 50% to 60% of AGI. But in 2016, we're going to go back to the 50% limitation for cash contribution. As a side note, there was an increase from 60% to 100% of AGI in 2020 and 2021, and this is part of the COVID Relief Act. But for now, we know cash contribution is going to be subjected to the 60% limitation, and when we get to 2026, it's going to be back to 50%. Aftermarket deduction. Some of you may remember before 2018 tax year, we used to have an overall limitation. This is something that we also refer as piece limitation. So what it is basically a limitation that lower the total aftermarket deduction by 3% of the amount by which the taxpayer AGI exceed a certain threshold amount. So the Tax Cut and Jobs Act basically suspended that piece limitation from 2018 to 2025. But if nothing changed in 2026, we're going to see that piece limitation again. Currently, we have 10,000 limitation for state and local income tax, but it's going to be expired in 2026. Market interest deduction. Prior to the Tax Cut and Jobs Act, taxpayer can basically fully deduct market interest if the total primary and secondary market interest was not exceeding the $1 million plus the $100,000 in home equity. But the Tax Cut and Jobs Act basically lowered that threshold amount from $1 million to $750,000 and suspended the deductibility of home equity loan unless they are used to buy, build, or substantially improve the taxpayer home. There's some other miscellaneous items. One of them is the business loss limitation. The Tax Cut and Jobs Act imposed a new business loss limitation under Section 461L. Under this new loss limitation, taxable loss from a traded business is going to be limited to $500,000 for married filing jointly and $250,000 for all the individual taxpayer. The amount would be subjected to inflation adjustment. So, for example, the overall limitation was $540,000 in 2022, but it would be $578,000 in 2023. This provision was scheduled to be expired in 2025, but the Inflation and Reduction Act extended the limitation to 2028 tax year. Personal casualty loss. Prior to the Tax Cut and Jobs Act, for individual losses from loss of property not connected with a trade business were deductible as a personal casualty loss if the loss were incurred from theft or a nature disaster. But the Tax Cut and Jobs Act disallowed deduction for personal casualty loss unless it was incurred in a federal declared disaster. But this sunset provision also expired by the end of 2025. So if nothing changes, we may see it again in 2026. Miscellaneous 2% deduction. Some of you may remember before 2018 tax year, individual taxpayer used to be able to deduct certain miscellaneous deduction. One of the most common type of these expenses is the investment expense for a broker account. So this expense used to be subjected to 2% of the ATI limitation, but starting in 2018, the Tax Cut and Jobs Act basically suspended the deduction for these expenses. But that sunsetting provision is going to be expired in 2025. So if nothing change again, we're going to see that deduction available again in 2026. Moving expenses. Moving expenses used to be deductible under Section 217 if certain conditions were met. However, the Tax Cut and Jobs Act temporarily suspended the moving expense deduction for the tax year from 2018 to 2025. The deduction would be available again in 2026. Personal exemption. Prior to the Tax Cut and Jobs Act, each taxpayer and dependent would be allowed a deduction called personal exemption. This was before 2018, and I remember the deduction amount used to be about $4,000 per individual in 2017. But the Tax Cut and Jobs Act suspended the personal exemption for the tax year from 2018 to 2025. So if nothing changed, we're going to see that personal exemption deduction again in 2026. Child tax credit used to be $1,000 before the Tax Cut and Jobs Act, but the Tax Cut and Jobs Act increased that child tax credit to $2,000 until 2025. So those are some of the temporary provision for individual taxpayer. I'll take a second to see if anybody have any other question.
I had a question that popped up. Kind of going back a couple slides, you noted there's a pretty strict limitation, $10,000 on state and local taxes. Are states doing anything to curb this effect so that taxpayers are able to deduct more than just $10,000?
Yes. I think because of this 10,000 limitation, some states that have income tax provide an election called pass-through entity tax election. So with this election, a partnership or an S corporation can deduct the payment for state income tax at the pass-through entity level. So it doesn't get passed down to the individual taxpayer and would be able to avoid that 10,000 limitation. So I think it can be a good tax saving opportunity if some partnership or S corporation have significant income tax. But because different states they have different rules regarding to how and when to make the election, so you definitely want to reach out to your tax advisor before you plan for that election. But that's a good question. Do we have any other question?
One question that popped up dealing with exemptions coming back. Will the standard deduction change in 2026? I believe the answer to that is it will revert back to what it previously was, but we're still waiting on some guidance on what that exactly is going to look like when it switches back.
I think we're still waiting because we only know what we know, and we only plan for what we know so far. But I think we continue to watch out for any change that may coming. But this is what we know so far. So I think we can only rely on what we know when we do tax planning for 2023 and the future tax year.
So kind of looking at all of these sunsetting provisions from the individual side, I know there's a lot of other areas of taxation that are out there. Can you guys touch a little bit more on some of the other areas that are looking to sunset?
Sorry, say that question. I'm sorry, I didn't hear that.
Just looking, so you talk through some individual sunsetting provisions.
Yeah.
What other sunsetting provisions are out there?
Yeah. So yeah, we also have some other sunsetting provision for business and estate. And I'll pass it to Swarb, and she can continue and talk about those provisions for businesses. Sure.
Yes. Hi, everyone. Yeah. Okay. So I'll be discussing some of the sunsetting items. So the Tax Cuts and Jobs Act was enacted several years ago, but we can still see the impact it has. So as you can see, some of those items, uh, it's been changing. It's remained the same for the past few years, but it's starting to change in going into 2022 and 2023. So the lifetime exemption with Tax Cuts and Jobs Act, it doubled what it was, and every year since it's been adjusted for inflation for 2023. It's projected to be 12. Sorry, it's going to be 12.92 million per individual, and it's set to go back to what it used to be in 2026. Of course, it would be adjusted for inflation. And the bonus depreciation that we've been enjoying for the last, I guess, 5 years, it was set at 100%, but starting January 1st, 2023, all assets placed in service, they will only qualify for 80% bonus, and then next year it's going to be 60%, and then the year after 40%, and by 2027 it's set to go back to zero. So let's go to the next slide. Okay, and another item that was brought on by TCJA was the qualified business income deduction. So how that works is you get 20% deduction based on QBI, but it is limited to the greater of 50% of taxpayers' wages in the qualified trade or business, or sum of 25% of taxpayers' share of W-2 wages, and 2.5% of the unadjusted basis of property, or also known as UBIA. So it was passed, so it would kind of level the playing field between corporations and pass-through entities, because corporations got that flat 21%. And so this would bring down the tax rate for some of the pass-through entities from 37% to 29.6%. And currently this is set to go away in 2026. So this is this is one of the non-sunsetting items. So this looks like it'll be permanent. So research and development expenses before January 1st, 2022, taxpayer could choose to either expense these or amortize these over 5 to 10 years. But starting January 1st, 2022, they're required to amortize it over 5 years if they are domestic expenses. And if they're foreign expenses, they will have to be amortized over 15 years. And I think taxpayers are hoping there would be additional guidance, but nothing has come out this year. So yeah, it looks like it's here to stay. The other non-sunsetting item is 163J business interest expense limitation. So basically, this is the calculation prior to the changes in 2022. So if an entity or an individual, they're subject to 160J, they would be limited to 30% of the ATI. And in 2022, what happened is taxpayers are no longer allowed to add back depreciation and amortization. If we could go to the next slide so we could see the 2022 computation. So as you can see, the ATI, what makes up the ATI, just fewer items. So therefore, most likely your ATI, if you have amortization, depreciation, you are not going to be allowed to take that into consideration. Therefore, your ATI would most likely be lower than what it used to be, and therefore your interest expense that you were anticipating to deduct would just be a lower amount. So if we could move to the next slide. So you can see the difference. So with the same exact numbers in 2021, your interest was not limited, whereas in 2022, $10,060 is being limited. And what happens with that limited business interest expense is you just carry it forward to the next year, and you'd have to run this test again if you are subject to 160 TCJA in the next tax year. The reason it's important to track these is because you might not be able to utilize in the year that you like, but in the future, those deductions or expenses could be released. And so the one other thing that I've seen is that if you receive a K-1 from partnership, there is excess business interest expense on line 13K. And even though it is excess business interest expense, that deduction will likely not be deducted in the year that you're receiving the K-1. It will likely be carried forward, and then in future, when there is excess taxable income or adjusted taxable income, enough to take those deductions, those losses or those deductions could be released. Okay, so time for questions, if there are any.
Are there any chances, or what are you guys' thoughts on the possibility of any of these provisions being extended or being modified?
I think as of right now, no, but we'll kind of track it if there's any new guidance that comes out. But the one that I think the bonus depreciation, in my entire career, I've never seen it be zero, and so there's some like hope on that if they decide to change it. But really, who knows, right?
Agreed. Hopefully they could do something with the R&D expense limitation. Are any of these possible to be retroactive?
We really can't say right now.
We talked about some of the sunsetting stuff. There's got to be something going on. Is there any legislation to consider that's happened somewhat recently?
Yeah, so there was the Inflation Reduction Act, and it was in end of 2022. There's updates. There's been updates this year on that as well, but there's been a lot of good things coming out of that for taxpayers. But yeah. Okay, so well, I said good things, but so there's been an extension of excess business loss limitations. So this was originally set to expire at the end of 2025, and as Aiden mentioned earlier, but this is kind of, I think, just similar to individuals' version of the 80% limitation for corporations. But that's set to expire in 2028. And then there's the stock buyback excess tax. So this began January 1st, 2023, but this really only impacts small pool of taxpayers. So how this works is there's a 1% excess tax on fair market value of certain securities that are bought back. But it really, this is probably a very small pool of taxpayers. And I think this was passed so companies would not buy back the shares, so they could raise their share prices. So that was the reason behind it. And there's some more items on this act. So if you could move to the next slide. Okay, so we know that the Tax Cuts and Jobs Act repealed the AMT tax for corporations. So this brings it back, but also this only impacts certain types of taxpayers. And so the criteria is that if your adjusted financial statement income averages to more than $1 billion in the past 3 years, you might be subject to this new 15% AMT tax. Also, there was some modification to the energy efficient commercial building deduction modification. So this calculation is a little complex, but the idea is that they just lower the threshold for the energy consumption. So it was reduced from 50 to 20%. 25%. So if you reduce the energy consumption by 25%, then you would be eligible to take some deductions. And the way they calculate the deduction is per square foot. So let's say you're modifying a building. There are 3 components to what you could be modifying. It could be lighting fixture, it could be HVAC, or just like the building itself. And if let's say that the modifications that you made, you've covered like 1,000 square feet, then you would take the square feet and then take anywhere from 50 cents to $1 per square foot and take that up against the cost basis of the total property placed in service. So that deduction you would immediately get. Whatever you're reducing the cost basis by, the cost basis would then just be depreciated over 39 years. So it's a complex calculation. And if you are curious, or if you're wanting to utilize this, I think it's best to contact your tax advisor or the architects or the builders that you would be working with. But yeah. Okay, so there were also a lot of energy efficient credits in this act. So the big one being a new clean vehicle credit. So you can get up to $7,500 for purchasing clean vehicle. And then for used vehicle, it's up to 30% of the sales price, and then maximum of $4,000. Also, there is credits out there for commercial vehicle as well. So that's up to 30% of the sales price, and it would just have to be used on public street roads and highways. This credit is available all the way through 2032. And there might be other limits to this, but yeah, so, and then there is residential energy efficiency property credit. This has been a common one. So it increased the credit from $500 to $1,200 per year. And they also repealed a lifetime credit limitation with this and extended this credit all the way through 2032. Also, there is a $2,000 credit if you were to place in service a heating pump or a boiler. So there's a lot of credits out there. The one that I recently found out about was the solar panels. So like if you place solar panels in your home, you could qualify up to 30% in credits, and so but things to kind of watch out for is that some of these credits are non-refundable credits. So you could maybe time it right in the year that you could utilize those credits. The solar panel specifically, that one, you can carry that forward to next year. So yeah, so there's a lot of credits out there that could be utilized. It just depends. It's a good talk to have with your tax advisor, maybe before purchasing a vehicle that you think might qualify for the credit. There are certain rules and limitations, so they might be able to help you with that. And then I think next slide. Yeah, so I think Matt's going to take it from here about any proposed legislation.
Yes, I'll touch base on this. It's a somewhat misleading of a slide to put up because additional proposed legislation is going to go through a lot of different forms. We've seen a lot of possible changes coming through and possible new legislation that's been written, but it needs to go through the process to determine what that ultimately looks like. So going way back in time, all the legislation we've talked about started on the cutting room floor and was looked at and examined. It started as one piece of legislation, and it almost seemed to took a completely 180 turn when it eventually got signed into law. So one thing we'd like to caution taxpayers looking at legislation is making sure that you're looking at the final piece of legislation. Proposed legislation, it can be very misleading in that it probably won't be the final version of the law that gets put into place. So kind of thinking that through and kind of understanding all of that, how would a taxpayer plan when there's so much uncertainty in proposed legislation and anything that could possibly come out?
Yeah, okay, so there's still a lot of things that we could be doing. As we saw in our last slide earlier, the fixed assets, the bonus depreciation is going to get reduced from 80 to 60% in a couple of months. So if you have any assets that you want to place in service, does it make sense to purchase them a little earlier and just place them in service? Restructuring debt. So the interest expense, so the interest rates have been pretty high lately. And so if you're considering restructuring your debt, if you are subject to 160J, would your interest expense be limited? That's something to consider, before restructuring debt. Also, there's a way that you could maybe maximize your 199A deduction or your QBI deduction. So let's say that, there's bonus that could be issued a little earlier or delayed by a couple of weeks. There's ways you could possibly calculate what would maximize the deduction based on your wages. Also, tax rates have been pretty low. So if you're at a place where you could consider accelerating revenue, that's also an option. There is you can elect out a bonus if that makes sense for you, if you'd rather take those deductions in years to come. And then also installment sale recognition. If you have proceeds that you want to time this year or the next year, it makes sense to do that. We have about a couple of months till the year end, and it also might be a good time to look at the receivables and see if there's any bad debts there, and then inventory valuations and all that. So I'm gonna pass it on to Aiden here, and he's gonna discuss some of the more that you can do.
Another opportunity that the taxpayer wants to consider is loss harvesting. So it is especially for the taxpayer that have or anticipate to have a significant capital gain. They may want to consider selling some of the capital investment that may result capital loss, so that they can use it to offset against the capital gain. There's a special rule about the capital gain or loss because in general, a taxpayer could only use the deduction for capital loss to offset against the capital gain. So as we plan for next year, before we get to the end of the tax year, maybe take a look at what we have so far, how much capital gain we have, and reach out to your tax advisor or even your fund advisor and see if there's any opportunity out there for you to sell some of the stock, so you can reduce the total overall capital gain that you may have for 2023 tax year. This can be a tricky part. The tricky part with this planning is, say, if you plan to buy them back, make sure you have to wait for at least 30 days before you buy them back. Otherwise, you're not going to be able to deduct the capital loss that was generated from the sale of investment. Another thing that you may want to consider is if you sell some type of non-traditional type of investment like PTP, because there's some special recapture rule related to this type of investment. So make sure you reach out to your tax advisor, give them a heads up, and maybe they can give you some idea. Maybe they can tell you what the tax consequence going to be from the sale of this investment, so you can plan ahead for next year. So those are some of the planning items. Do we have any other questions? Okay. Well, Matt, we have question?
Nope.
Yeah. So I think now with all the tax provision that we discussed so far, and also all the planning idea, what do we do? What do we do now to prepare for the next tax seasons? And outside of the regular item like 1099, K1, those forms going to be available early next year. But what can we do now to prepare for the next tax seasons? And one of the common items is, if you have a sale of home, you may want to gather all information related to that, keep it in one place, or you can even send it to your tax advisor so they have it handy when they prepare your tax returns. Also, if you have a new business or new type of investment, it's a good idea to let your tax advisor know so they get a heads up and be watching out for some new tax document when it comes to the time when they prepare the return for you. Vehicle mileage, if you have a vehicle that you use it for trade, for business, keep track of your total and basic mileage, because those are some important information that we may need to prepare the return. And I see now there are a lot of people invest in cryptocurrency. I think cryptocurrency can be different depending on what platform you use, but it is important to keep track of how much you pay for, how much you spend to invest in this type of investment, and how much you sell them for. So in the end, we need all this information to be able to calculate the gain or loss from the sale of cryptocurrency. So definitely this is some of the things that you can do now. The sooner we plan ahead for the next tax season, the better we are. So, but the rule of thumb is that if you have any new in 2023, good idea to start a conversation with your tax advisor early. Let them know that this is something new that you have for 2023, so they may give you a heads up, like some guidance on what you need to do to prepare for the next tax seasons. I think we still have we have 10 minutes left. I think next we can go to Q&A session. If anybody have any question.
I have another question. So if you're getting into some of these other areas, you're buying a new building, or you're wanting to take advantage of these commercial property deductions, what are some other items to consider ahead of time going into next year?
Yeah, that's a good question. Like I think Swart mentioned earlier, right now we still have pretty high percent of the bond depreciation. For 2023, it's going to be 80%. So if depend on the fact and circumstances, maybe you want to consider having a concept study to identify how maybe accelerate some of the depreciation for the new building that you have. But you definitely want to reach out to your tax advisor, and maybe it's worth to go through the cost and benefit analysis to see, do you benefit from doing the cost seg? And if you plan to do it, maybe it's better to do it early than later, because cost seg study can take some time to get it done, and a tax preparer would need that information to prepare the return.
I think also a good thing to point out, staying in contact and making sure everyone's apprised of what you're doing, contacting and being in touch with. If a change of ownership is happening at a business, to be in touch with attorneys and making sure everything's documented properly. Also being in touch with, again, any of your third-party professionals that you're working with, because everyone has different deadlines, and we want to make sure we're all meeting the proper deadlines and meeting the needs of all of our clients, and then anyone else on the call that has the various tax advisors, to get everything wrapped up in a timely fashion.
Yeah, it's all about planning. Anything that we can plan now, we can do it now, because I think now is a good time to save some time for before get to busy time.
And we as tax advisors, we're trying our best to minimize tax as much as possible within the law. So if anything changes, I know we'll be on top of what's going on, and we'll be able to communicate with everyone as quickly as possible. Looking at, I don't see any other questions. One popped up dealing with credits for vehicle credits. Are those available for businesses, individuals, both, or are all those going to work?
So for individuals, there's that $7,500 if it's a new vehicle, and then I think max $4,500 for if it's a used vehicle, and then for if it's a commercial vehicle, then it's going to be 30% of the price, and then it also depends on the weight. So it's a very and then there are other criteria where the vehicles would have to be built. So it's a very it's kind of specific. So it depends on what vehicle that you're trying to purchase, or buy either for yourself or your company. So that's a question that you should maybe run with your tax advisor before making the purchase.
I think the other side too is, hopefully, and I believe they're going to, the sales, the manufacturer would have to provide some information to qualify for this credit. So make sure you're talking to them as well before buying the car, to make sure that this documentation exists, versus saying, I know from a tax advisor perspective, I qualify for this credit, usually doesn't cut it. We like to see some documentation than just, I bought an energy efficient car.
Yeah.
Well, good. I think we're running a little bit early, but want to thank everyone for attending, and thank Aiden and Swaroop for putting this together. Very helpful. If you have any further questions, we'll try our best to answer them, and want to thank everyone for their time, and hope you have a great rest of the day.